So remember, this game's about liquidity. We had a serious liquidity crisis in COVID. It was like all hands on deck. The economy was shutting down. No money was flowing. The Fed had to pump in emergency funds at zero interest rate to inflate that global economic boom, expanding our money supply because the Fed has been restricted. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop. Hey, it's KP coming to you live from Corona, California. It is just about 10 p.m. on Monday night. Completely caught up with all my emails, getting back to everything, and I've got a decent amount to talk about, but not as much as last week, so hang in there with me. Okay, what's going on in the world of mortgage and everything today? So every Monday, the Mortgage Bankers Association has basically an executive call where they talk about all the issues they're working on, like trigger leads and where it's at. And one thing they announced today, which the press picked up, of course, they put it on email yesterday, and the press picked it up early this morning. The NBA opposes the GSE merger and supports explicit government guarantee. So they don't want Fannie and Freddie to be combined. And so in the same light that the FHFA, the regulator over Fannie Mae and Freddie Mac, wants to spur competition and have Vantage scores in addition to FICO scores, NBA says, well, what's good for the goose is good for the gander, right? So keep Fannie and Freddie both. And they both do different things and have great leadership teams and have different approaches, even though there's a fungible universal mortgage-backed security that you can pile all your Fannie and Freddie loans into. So I thought that was a pretty good case. Obviously, when you talk about an IPO, that means the thought is if you're going to go public and have one initial public offering, that you would be combining them if that's what this administration wants to do. So don't know where it's going to go. It's going to take some time. And Barry Habib and Dan Habib at MBS Highway had a great session last week where they had FHFA Director Bill Pulte on. And he answered a lot of questions. And so it was really good to hear him talk. So anyway, we'll get more guidance on that. Another announcement I thought worth mentioning, John Hedlund is announced as the 2026 MBA Vice Chairman. Really good dude, solid friend of mine, one of the co-founders and a partner over at AmeriHome, which was purchased by Western Alliance Bank, one of the big aggregators that we sell loans to. A lot of independent mortgage bankers sell loans to. So congratulations, John. You are a good man and a good friend. He's also vice chairman currently at ICE Mortgage Technology. So I think I've mentioned in the past, gives a little bandwidth for their president over there, Tim Bowler. So all good news coming out of that today. Okay, so let's get to the markets. What's going on this week? I saw this week, the National Association of Home Builders, they had some confidence numbers that came out today. Not the best. And housing starts will come out tomorrow. MBA applications Wednesday, 20-year bond auction, pretty important. The Fed minutes from the last meeting. We're about just a little over 4 weeks away from the next meeting, although we have Jackson Hole at the end of the week, and I'll explain that in a second. Jobless claims, leading indicator on labor, really good data as far as leading indicator. It's like your locks, right? You get locks in the loan, kind of gives you an idea what your fundings will be like, and then you project in the short and near term. Same thing with jobless claims. Unless, of course, you just think all the data is terrible. Existing home sales comes out again this week, and that's a big component, right? I think Ivy Zelman and team at Zelman and Associates, which is now a Walker Dunlap company, have 4.95 million annualized existing home sales. So we'll see. And then the big one, of course, Chair Powell speaking at the Jackson Hole Summit. So the Kansas City Fed has this summit that they host in Jackson Hole, Wyoming, which I'm sure is beautiful this time of year. And it's been market moving in the past. So a year ago at this meeting, Chair Powell basically said, we think it's time to pivot. And they were basically saying they're going to cut at that next meeting, which I think was September 18th last year. Didn't say, hey, we're cutting 50 bips and we're going to get rolling. So it was market moving. I don't think it'll be as market moving this time. Uh, it could be for that day, and but we're going into a weekend. What I think is more market moving is price action currently, and so I'm going to do some graphs with you. I'm going to use my hand to make some curves because I don't have a production crew here. It's just me at my desk with my audio that sometimes doesn't work. I did test it 3 times briefly, so this 4th time, you may not see this video if I replay it back and the audio is terrible. I will be pounding my desk and dropping F-bombs, raging, as my son likes to say. He's like, bro, why are you raging? Because you guys pissed me off. Anyway, okay, so this time around we have uncertainty with tariffs. And we've already cut 100 basis points. And it took a while for rates to kind of catch up. Rates are in a good spot right now, even though this last couple trading sessions, especially since that PPI report last week, in this range that we're at, let's call it 432 down to 420, the Elon line, as I like to call it, Elon Musk line. He likes to, 420. If you rolled out robo-taxi fares for the cyber taxi in Austin, and it was a flat fare of $4.20. Joe Rogan, his famous time where he supposedly smoked weed for the first time. Anyway, so we're at the upper end of the range right now. So what could move it higher or back down? This week I just mentioned a couple things. There are some potentially market moving things, maybe some Fed speak, but really just price action, right? So stocks and bonds. The stock market, I am not a financial advisor. I am not responsible for your losses, only your profits. The stock market has been ripping at all-time highs ever since Liberation Day and that kerfuffle. And so money has clearly been flowing into the stock market and cryptocurrency, by the way. So I'm still a huge fan of, I think Ethereum has huge upside. Bitcoin's still going to run long-term. Digital gold. Ethereum is like Microsoft Windows, where all of your contracts are done. Look at Microsoft, how they've done over the years, absolutely crushing it. I think Ripple and Solana are probably some other ones. Again, not making picks, but when money is flowing into these other assets, and you start to see some fringy stuff like Open Doors, or which they just changed their CEO, or memes, GameStop, or the meme coins, whatever. Things get a little frothy. I'm not saying they are right now, and I'm not saying this bull market can't continue to run. We still have NVIDIA yet to report at the end of the month, which is kind of like the big showstopper. I mean, they're the biggest company in the world. They're the center of the AI universe, which is impacting everything, jobs and inflation. We have all of our big box retailers this week, like Walmart, Target, Home Depot, and some others. How's the consumer doing? Are they spending? Remember, we've got this K-shaped economy. The wealthier, like the top, I think 10% are responsible for 50% of spending in the country. And so the lower half, not doing so well. We know that. So, these earnings reports matter. But if stocks decide, hey, if the institutional traders who trade on, like, they don't pull out their phone and trade, Apple stock, Warren Buffett didn't decide to, the 13F filing, my goal in life, the 13F filing, my lucky number 13, August 13th, Friday the 13th, all the things. If you have $100 million in assets or more, you file with the IRS quarterly a 13F form, and you disclose what you did. So you see people like Warren Buffett, Berkshire Hathaway, Bill Ackman, all these great institutions. What are they buying and selling? Apple sold. United Health was a large position taken by Berkshire Hathaway. And so they don't just whip out their phone and start, trading on an interactive broker like me or Robinhood or whatever. I mean, they trade in dark pools, hidden exchanges, overnight. Hey, we're going to buy $2 billion in United Health. That's a big trade, right? So these kinds of things move the market. Well, if institutional traders start to sell because they feel like, we're in the high end of valuations, maybe this run's gone on long enough, Labor Day's coming up, I don't want to mess with it. Who knows what could happen in the world. Maybe the deal that's supposed to go off in Alaska doesn't happen between, the U.S. and Russia and Ukraine, oil spikes, whatever, all these different things. I don't know, but if the stock market starts to sell, I could see that actually being a big driver of bringing 10-year treasuries down. But the Fed doesn't really, they don't really care about 10-year treasury. And I think Chair Powell mistakenly said the 20-year treasury note yield is what more mirrors interest rates in one of his press conferences. Call that guy a question there. The 2-year treasury yield is what is the barometer of kind of the short term, how the smart institutional bond traders on Wall Street think the economy is doing. It's at 377 at this moment. It is screaming for a 25 basis point cut. It's been under 4 for a long time. I mean, certainly since like early June. But after that horrendous jobs report, the calculus changed, and that 2-year Treasury is way down. There is clear guidance for a cut of 25 basis points for the Fed funds overnight rate, which is most closely linked to shorter-term Treasury yields. I know that's a mouthful. Watch the 2-year Treasury, 25 bips. So a hawkish cut could be in the offing. What is a hawkish cut? And we'll be hearing that all the time. The last hawkish cut was in December, which was the last 25 basis points of the 100 basis points of cuts towards the end of last year. And why it was hawkish is because, the curve was, hey, we're going to have 4 rate cuts after this cut in the year of 2025. This is time warping back to December of 24. But then not only on that dot plot did they say, hey, we're not going to have 4 rate cuts in 2025. We're only going to have 2. So here's my curve flattening the curve. So instead of this many cuts in a shorter amount of time, 4 and 25, they said they were only going to do 2. So they extended it out. Now, the September 17th meeting coming up in just over 4 weeks also has a dot plot. So to split the baby, compromise, make everything fine. Yep, tariff concern, inflation still a concern. We're still not sure. But we think we have room for 25 basis points. But that's it for now. We're going to sit back and watch data. And if they change the curve, if they say, because the year's running out, there's only so many meetings left between now and December, how many cuts are they going to do this year? And that could change the calculus of the market. And it could be a cut, which actually sells the market off because it is hawkish. So some unknown things coming up. Will Jay Powell say anything on Friday at the Jackson Hole, Wyoming, to that effect? Or do we have to wait for about 4 weeks and a day or two, 30 days, when we get the information at the actual Fed meeting? Will there be more dissenters? Will there be more people on the board? Will he finally coalesce them and go, yep, we're all together now. We're all going to cut. Can't be having no dissenting votes like we haven't had in 50 years. Can't have more than the 2 we had the last time because everyone's auditioning for the shadow Fed president that's due up. So, retail sales was okay. Again, it was okay. But we'll see if we get that hawkish cut. Now, talk about bending the curve, okay? So remember, this game's about liquidity. We had a serious liquidity crisis in COVID. It was like all hands on deck. The economy was shutting down. No money was flowing. The Fed had to pump in emergency funds at 0 interest rate to inflate that global economic boom. We don't have a liquidity crunch. In fact, the M2 money supply, which is a measurement of money supply in the country, is actually growing. It's been growing since last year because we've been spending like a drunken sailor. The Biden administration spent like crazy in their first quarter of fiscal year 2025. Then we passed a one big beautiful bill, which raised the debt ceiling to $5 trillion. We passed a $4.2 trillion budget, and so we don't have a problem with money supply, but tariffs could cause a money supply issue. So hear me out. Professor Jeremy Siegel is on CNBC all the time. He's a professor at Wharton School of Business, UPenn. He's also on the advisor board of Wisdom Tree. Tariffs are a consumption tax. They are taxing the consumer and drain liquidity out of the system. And Treasury Secretary Scott Bessent has said they're going to take that money where we have surplus now, like first time since forever, in the Treasury because we're taxing whoever, whether currently Goldman Sachs is 64% of tariffs are taxing, the actual importers or businesses, and it hasn't hit consumers yet. And so, 20 trillion here, 30 trillion here, we could raise, a lot of money and pay down debt, and that is money that is leaving the system, which reduces the money supply. So it all kind of works together, this flow of money. Bitch didn't know that. Very interesting to hear. If rates come down to 6%, the National Association of Realtors said that 5.5 million more households could afford the median-priced home, and roughly 550,000 people would buy a home within the next 12 to 18 months. So that's a big deal and a big, obviously, boom for an advocate for rate cuts. So I could get into all this stuff, but I will have one opinion piece right here about the CFPB. If you waited for me this long, the CFPB The court was thrown out 2-1. Labor unions don't have any right to tell the government what to do. So CFPB job cuts are coming. Now, this is my opinion. This does not reflect PRMG or anyone else, but I keep hearing like, beware, 50 CFPBs, 50 CFPBs, 50 states will come at you. Well, I got good news for you. They come after us all the time anyway. So there's really only 7 of them that are tough. And you know what the CFPB never did? The CFPB never did. They never went and got people who committed fraud. I got millions of dollars on our balance sheet for people with straw buyer scams, committing fraud, get them out of the business, take them to court, put them in jail, get rid of their license, and don't let them have their livelihood ever again. Who's going to do that? I hope the states do that. That's the biggest problem I see out there right now. Have a wonderful evening. Cheers.
Hey, it's KP coming to you live from Orlando, and I'm at a dinner at NAMMBA Connect with Radian. Hello, there's Angela and Randy, Deanna, and of course, good folks from CNB hanging out. We're doing our thing. All right, so the conference is at the JW Marriott, which is like the next hotel over. Tony Thompson, founder, incredible group. It's National Association of Minority Mortgage Bankers of America. Their mission is insane. Check out their ASIL, their accredited social impact lender. Only 5% of lenders have their ASIL designation. So we all want to take a look at that and set the standard high for diversity. And the sessions were crazy today. Got to see Joe Wilson and Ashley at Social Coach do their thing. Saw Roxana and Aldo, a big purple dot up there with Amir Sayed. And yours truly was on a panel with Laura Brandeo and Alan Middleman, and of course, the great Sue Woodard, and talking about the future of lending. So here we are. Enough about me. What's going on? Okay. Let's do housing news, and then we'll talk about the Fed. I would love to go out back and give you like some Disney-esque stuff. It's a little rainy. Obviously, we have a lot of housing news that's come out. Existing home sales came out today. 4 million, over 4 million. So back over 4 million annualized units sold from existing homes. I mean, someone that owns a home and then sells it. People were scared psychologically after Liberation Day and the tariff kerfuffle that we talk about a lot here. And so, of course, they kind of probably held back on listing their house and doing all this stuff. I wish you could see this. It's actually very pretty, but my camera just can't quite do it. The other side of the camera is really good. Existing home sales, a little down in June, a little up in July. So, steady as she goes kind of market. And, of course, home builder confidence was a little low, but that's just because rates are a little high, elevated. We're at the top of the 10-year Treasury range at 4.32 today. Got down around 4.27 yesterday. We had a little bit of a couple days sell-off in the stock market, and that money rotated out of big cap growth tech and kind of made its way into bonds, and rates caught a bid the last couple days. The Fed is speaking tomorrow. So Chair Powell is speaking in Jackson Hole, Wyoming. So the Kansas City Fed, they put on a symposium every year around this time in Jackson Hole, Wyoming, and central bankers from all over the world are coming. And it's a big deal. So a year ago, Chair Powell broke the news to the world, said, we're ready to start cutting rates. It was a big deal a year ago. I don't think this will be that market moving tomorrow. But unless he's dovish and says, yeah, the labor report was weak. We think labor is more of a risk than inflation. Remember, they have a dual mandate, right? Price stability and full employment, right? Which is inflation, prices, and the labor market, unemployment rate. They really have a tri-mandate. They don't really say it, but try and keep, stability in long-term bond prices. Remember, they're the Treasury salesperson of the world, and that's how we fund our government. That's really what they do. Why do you think rates are so high? Because we offer a high yield, and we want to make sure that, anybody is enticed around the world to buy treasuries and fund our government and get a solid return. It's hard to compete against the stock market that's been absolutely ripping since Liberation Day. When you're trying to sell treasuries at 5% yield on a 30-year long bond. So that's nothing compared to the stock market. But the stock market's finally showing some weakness. It's finally showing that it is a little overextended. And so when the stock market sells off, in September is traditionally one of the worst months in the stock market. I'm not a financial advisor, not responsible for your losses, only your profits. Although I did put a big put trade on today. Um, if the Fed, if Treasury, if Fed Chair Powell is not dovish tomorrow, if he's neutral or even hawkish, which would be worse, I think the stock market sells off because the market has baked in the stock market, the flow of money has baked in, last week a 98% chance. Now it's like 80 something percent chance of a 25 basis point cut September 17th. That doesn't happen, and that money doesn't flow from the Fed into the system, and we have more liquidity. I think the stock market will continue to digest its gains. And, that's normal. Like, there's some great companies making tons of money, but there's mean reversion out there, right? So, like, we're way overextended, we're way overbought. And there's a lot of money going to a lot of different places, risking to make money. And sometimes, institutional traders, retail traders, they just want to take profit off the table. And so you tend to see money flow into bonds, and that's good for rates. But what's really good for rates is weak economic data. So the Fed minutes were released yesterday, and the Fed basically said, hey, we have real concerns about inflation. And that was 2 days before the labor report came out. And the first Friday of August, which was weak. Now, if you have a weak jobs report and then another one back to back, the fear of the economy shrinking and not being as good as people thought is bond friendly, rate friendly. If maybe this report that comes up the first Friday of September for August jobs, which there could be more revisions for, June and July, if that's 2 weak ones back to back, then the thought of labor softening and the economy getting weaker may tend to override the inflation fears of the tariffs. And, if you have liquidity leaving the system, the Fed needs to, cut the rates. Now, they could do a hawkish cut 25 basis points, but say, this is enough for now. We're going to sit back and wait. Or you may get some indication tomorrow from Jackson Hole, like we're hawkish now or neutral now, and we're not really sure. We have a lot of reports coming out. We have a PCE report coming out at the end of this month. We have another jobs report coming out in September and 2 more inflation reports, PPI and CPI, before the meeting. And so the market may say, you know what? It's Labor Day coming up. Let's mail it in. We were supposed to get to sell in May and go away, but we didn't get to do that because of Liberation Day and all these institutional traders been working their ass off, and they didn't get a chance to enjoy the summer, and they may do it here at the end of the month. So, mean reversion, liquidity, all that kind of stuff. I talked about on my Monday video. I just reiterated it. Tariffs raising 20 to 30 billion a month from, importers and companies, which haven't fully been passing prices through yet. We really haven't seen it yet in the PCE or CPI. Okay, we saw the PPI, but that doesn't mean it flows through to the consumer. So yes, PPI was high, but does it flow through to the consumer and hurt the consumer? So we haven't seen that yet. Tariff money is paying down the debt, which is good. That's bond friendly as well, and drains money out of the system. So there's less liquidity. Now, the consumer, I read something yesterday. If you've hung on to me this long, which you normally do, because this is only 8 minutes in, I'm usually 10 to 15 minutes. We all know that GDP is 70% consumer spending. Capital expenditure, CapEx, by companies getting ready for this AI boom is almost the same amount of money as consumer spending right now. Well, think about that. If 70% of our economy is consumer spending, and that is coming down, very, very understated. Consumer spending is slowing, and it's almost slowed down enough to meet up with CapEx spending. That tells me GDP is going to be slow from a consumer's perspective. And so that's a big shift. It's a big shift in our economy. It's a big shift in liquidity. That CapEx spending, Meta, Microsoft, Google, Amazon, anyone else that's out there that's spending money on AI, will it translate into worker productivity? Will it show up now? Will it show up soon? If it shows up in worker productivity, it might also show up in job losses. So I found that absolutely fascinating. The CapEx is almost the same amount of money contributing to GDP as consumer spending, which has historically been 70% of GDP. You think AI isn't real? That stat right there should be a wake-up call. So where's AI going? We had a lot of discussions today about AI. We talked about AI voice and agentic AI and all that kind of stuff. And, we all know that Walmart and Amazon have robots everywhere in their factories. Physical AI, okay? We talk about large language models and ChatGPT and Grok and Claude and Gemini and all that kind of stuff, Perplexity. That's all great. That's going to be table stakes, okay? What's next? Agentic AI, agents doing work, helping us be better and do more and be more efficient, have more productivity. Will that result in job losses or just more output? Time will tell. Probably a little both. Physical AI. I'm just going to leave you guys with this. Physical AI is robotic AI. So you guys know I have a Tesla. I'm not trying to brag about Tesla, but it's probably the biggest AI project in the world. My car physically literally drives me while I look at my car. May have had a couple cocktails, gets me home safely, drives in a laser beam. There should be no more drunk driving deaths. Our parents should get a little bit more freedom at the end of their life when they can't drive. Take the keys away. Nope, we'll give you a Tesla. You can drive a couple more years, get out, walk around, go places you couldn't go otherwise. And of course, the younger generation one day will be like, "Ew, you drive? Oh my God, you actually drive a car?" That's where it's going. Robots, humanoid robots, Tesla. Did you know in China at the beginning of this week, there were 500 humanoid robots, physical AI, in the Beijing ice skating rink Olympic site, having games. They were running sprints, they were lifting things, they were doing stuff. That's coming. It's all coming. Some of you put iPads in an open house. You can put a robot in there. $30,000 robot, work open houses every weekend, have conversations, take applications, tee up your salespeople and your realtors on more leads, and do the more relationship building, because the physical AI, the agentic AI, and of course the large language models are all helping us be more productive and do more work. So anyway, rant over. Have a wonderful weekend. Brace yourselves for whatever Chair Powell says tomorrow, and we'll get back to you Monday from the desk. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.